Welcome back, folks, to Investor Diaries. This is our home ownership series, video 8. And in this video, we're going to talk all about refinancing. So, Nidish, what exactly is refinancing a mortgage?
Hey, welcome back, everyone. So, a mortgage refinance is when you break your current mortgage to start a new one, either with the same or existing lender. That's precisely the definition of mortgage refinance. Now, there are a few typical use cases when you would ideally want to go into a refinancing mode. Now, let's try to explore some of the opportunities where you would refinance and also why you would decide to encounter or embark on this journey. Appy, do you want to provide some insights into that?
Yeah, so I'll start with getting a lower interest rate. So, right now, it's a low interest rate environment. So, you might have taken a mortgage when the interest rates were really high, and you want to make use of this lower rate environment. Now, mind you, when you refinance, it means that you'll have to break the mortgage. So, you'll have to consider some of the mortgage penalties when you break. But at the same point of time, this is a good time to at least consider breaking your mortgage, trying to analyze what your mortgage situation is, and if it makes sense, well, go for it.
Another use case where you would want to go to refinance is to access more equity or access cash in your home. Now, when you refinance, what happens is typically your property is reassessed and appraised, and ideally, like let's say you decide to refinance in 3 years or 5 years after you bought the property. Typically, in most environments, your property's value has gone up. So if you earlier had an equity of 20%, now after refinance your property has gone up by a significant margin. Now your equity is 30%. So now you have a greater equity, and assuming you have a HELOC, you have greater access to cash. Now you can use this cash for a variety of different purposes, but that would be another use case why you would go on this refinancing journey.
Okay, and then I think the third one, which is really important to speak about, is refinancing to lower your or consolidate your debt. So, for instance, if you have credit and you have those credits at higher interest rates, and you have an opportunity to refinance and consolidate your debt and get all of them together, this is a wonderful opportunity. So, for example, let's say that you have an unsecured line of credit at, say, about 7 or 8% rate of interest, and in this lower interest rate environment time, you refinance your mortgage, you have more access to capital. So, this way you can transfer your debt from your unsecured line of credit to your refinanced mortgage, which will have higher equity, and thereby continue to enjoy that credit but at a lower interest rate.
Yeah. And this is something that we've been constantly and consistently guiding you throughout our home ownership series. Always focus on paying off your debt of higher interest with the debt of lower interest. Or if you have access to lower interest rate, please pay off your higher interest debt, especially credit card debts, home loans, any other unsecured line of credits. So now we've explored why and when you would typically encounter or embark on refinancing journey. So three things that we discussed are lowering interest payments, accessing higher equity or cash in your home, or refinancing to consolidate debt. Now let's explore what are the different opportunities or how do you go about refinancing. Abhi, do you want to give an overview?
Yeah, so let's just say that you are the owner of a house or you have a mortgage. And we'll take the example of you having a 5-year fixed term mortgage. Now, at the end of 5 years, you have a few options. You can either continue with the same lender, which in this case is going to mean that you are renewing your mortgage. So here you'll just continue making those payments. Yes, your interest rate might change a little bit, but it's essentially going to be the same mortgage to the extent that your mortgage number is going to remain the same. At the end of 5 years, you can also transfer into a different lender. Because you've completed your term, you would not have to make any mortgage penalty payments. But the biggest one of them all is refinance. Now, refinance can be done at the end of the term or it can be done during the middle of the term, which in other words means that you can refinance essentially at any given point of time. Of course, as we've spoken, the pros with a refinancing is that you'll have a higher equity in the house, which means that you'll have more access to capital. So if you have any requirement of money, you can actually take money from the house. All with the biggest assumption is that your house has appreciated in value over a period of time. So, Nidish, one of the questions would be, when I said that you can essentially refinance any given point of time, what could be some of the scenarios leading to breaking your existing mortgage contract early?
Yeah, so the ideal or the best case scenario is the current scenario when the interest rates are so low that you may want to consider breaking your mortgage early just to take advantage of the lower interest rate, right? So you break your current mortgage, let's say it is at 2.5% interest, to get to a mortgage of let's say 1% interest in the current market, 1.5 interest percent interest in the current market. But keep in mind, when you break your existing mortgage, there is a penalty that the financial institution typically levies. So what you need to do is essentially do a break-even analysis to see that if you go for the new mortgage with the new rate, do you save enough that it outsets or outweighs the penalty that you're paying to break the mortgage, right? But in certain scenarios, I've seen that, especially during this time, a lot of people have broken the mortgage to get a new mortgage just because the interest rates are so low. It doesn't ideally help if it is if the delta is about 1%. Doesn't really help. Again, it's best that you talk to the financial institutions to understand the penalty and then do the break-even analysis, because it depends on a variety of factors. The interest rate, it also depends on the end date of the mortgage, how close you are to ending the mortgage. So all those factors are considered while assessing the penalty.
Yeah, I think one of the things that people do really well, specifically when they're going in for a second term, is they try to assess their situation. So, for instance, if you know that you might have to sell off the house at a given point of time, then they might go for a shorter term mortgage, such as say 3 years, so that if they have to break the mortgage, then the penalty is less. Between fixed and variable, they might already do the math to try to understand where the penalty is higher. And third would be they would look at the terms and conditions of the financial institution. If it's a big lender, such as a big bank or a credit union, in which case it becomes very difficult to break the mortgage and the penalty becomes quite high if you're taking it from a smaller lender. So I think there are a variety of reasons and variety of factors that an investor should consider, but as we've said many times, that these are things which are more tuned towards more savvy investors.
Another way you would refinance is by adding a home equity line of credit. Now, let's go back to the scenario that we described earlier. You have 20% equity in the firm. Let's say out of $1 million house, your debt is 800K, and your the equity you have is 20%, which is 200K. Now, let's say the price of the home went up by 50%, like right over a period of 5 years. So now the home value is 1.5 million, but the debt still remains the same, which is 800K. So now what it eventually means is that your equity in the house just went up overnight, right? Because the debt portion remained the same. So with this example, now you want to tap into that debt, right? So when you add into a home equity line of credit, you can access the remaining portion. So you've refinanced, the house is appraised at 1.5, the debt is the 800K, your equity in the house is 700K. Now, when you typically add a home equity line of credit, approximately about 80% of that equity is available to you to withdraw and use for any other needs. So maybe you use it to pay, like we said earlier, you could pay your high interest rate of credit card or car loan, unsecured line of credit. But this is another situation where you would want to refinance your property.
Yeah, and in this example that Nitish has just provided, we've just considered zero, but also think of the fact that over the period of time that the price of the house has increased from $1 million to 1.5 million, you've yourself paid some of the mortgage payments. So let's say that you made $50,000 worth of interest payments, so your equity has increased by 50,000 more. So in this example, 200,000 was the initial amount, 50,000 that you paid later, and then $500,000 was what you gained in refinancing. So 750,000 is your equity.
So that was our episode on refinancing a mortgage. How do you do it? And what are the different opportunities or what are the different situations that you would typically want to refinance? Hope you all enjoyed it, folks. Let us know in our comments or give us feedback on how you enjoyed this or if you have any suggestions. And let us know if there are any other particular topics that you would like us to cover. So until next time, see you on Take Care.
Thank you.